While tech stocks rocket to historic highs, Bitcoin just got slammed into a brutal support line. But this isn't a random crash. It's a calculated capital migration. Some of the most valuable tech companies in human history are about to go public, and global hedge funds are aggressively liquidating their crypto holdings just to secure a piece of the pie. If you think this is a normal correction, you are completely missing the institutional pipeline.
People are really disappointed by crypto this year because, number one, they didn't go up when AI was going up. But in some ways, crypto is a downstream story of AI because as AI capabilities go up, we already hear it from a lot of those AI researchers, it's going to increase the need for blockchain because that's the only way to prove and validate transactions and actually protect us from AI. Last week, I think that there were some high-profile sort of, quote, AI security exploits, one that happened on the Orchid suite for Zcash, and that caused some panic. I don't know why it should have caused all of crypto to sell off. But keep in mind, AI exploits are happening at a rapid pace and an increasing pace across all of financial services. It's just that the publicly traded banks don't actually reveal the exploits. So I think that these attack surfaces are increasing everywhere, and we have to be mindful of that. And the third is, Wall Street is still tokenizing. It's a big innovation, turning money into software, tokenizing equities and real estate. These are composability issues that only happen on blockchain. So to me, I think the crypto narrative is still in good shape, but you're right. The excitement and the FOMO has been in AI.
Bitcoin and crypto have been unpredictable this cycle. Prices have moved sideways, sentiment has collapsed, and everywhere you look, investors are arguing about the same thing. Is this just another brutal chapter in Bitcoin's famous 4-year cycle? But what if they're looking in the wrong direction entirely? What if the real reason Bitcoin is struggling right now has very little to do with the halving, historical cycles, or even crypto itself? Because beneath the surface, something much bigger may be happening. Think about what's coming next. Two of the most anticipated companies on the planet are moving closer to public markets: SpaceX and Anthropic. SpaceX, Elon Musk's private aerospace giant, has been valued in private markets at roughly $350 billion. Anthropic, one of the leading artificial intelligence companies competing with OpenAI, has recently been valued at over $60 billion and continues attracting billions in institutional capital. These aren't ordinary IPO candidates. These are generational assets. The kind of opportunities pension funds, sovereign wealth funds, venture firms, hedge funds, family offices, and institutional investors wait years to access. And when opportunities of this magnitude appear, capital doesn't magically materialize out of thin air. It gets pulled from somewhere else. Historically, when major liquidity events approach, institutions begin repositioning. They trim risk, raise cash, rotate capital, and prepare for allocations they believe could define the next decade. Could that be happening right now? It's impossible to prove with certainty, but it would help explain why Bitcoin has struggled to gain momentum despite ETF adoption, increasing institutional participation, and growing long-term conviction. The bearish interpretation is obvious. Perhaps demand is fading, but the bullish interpretation is far more interesting. What if Bitcoin isn't being rejected? What if it's simply competing for liquidity during one of the biggest capital reallocations in modern market history? Because if trillions of dollars are preparing for the AI revolution, then companies like Anthropic and SpaceX sit directly at the center of that story. And here's where things become even more fascinating. Michael Saylor has repeatedly argued that Bitcoin isn't competing with technology companies at all. Saylor argues that the biggest story isn't short-term volatility. It's the long-term movement of capital towards scarce, high-quality assets. In his view, markets regularly experience periods where money appears to leave one sector, only to return later with even greater force once liquidity events pass and uncertainty clears. Like what is currently happening with SpaceX and Anthropic, the question isn't whether institutions want exposure to innovation. They clearly do. The real question is whether Bitcoin's current weakness represents a warning sign, or simply the cost of admission before the next major wave of institutional capital enters the market. And that's exactly where Michael Saylor believes investors should be paying attention. Listen carefully.
Let me just say a few words on the market right now. In the year 2026, there'll probably be $1 trillion of capital that's going to flow into AI and the hyperscalers. We can see it right now. In the last 3 months and the next 3 months, $400 billion of capital is being raised by OpenAI, by Anthropic, by Google, by SpaceX. You're literally watching an $85 billion IPO in SpaceX, an $80 billion offering by Google. No one ever dreamed that the company generating infinite cash, Google, is going to go to the market and ask for $80 billion more. Anthropic's doing an $80 billion raise. So what you have right now is a massive capital rotation, $400 billion in just a matter of weeks rolling into AI. About 1% of that, $4 billion has rolled out of the Bitcoin ETFs over the past 14 days. You have a portion of capital. Clearly, people they're not financing the AI trade with all crypto assets, but 1 or 2% of the market is crypto. And there is a reallocation to get ready for these massive IPOs. That has created a downward pressure on the price of Bitcoin, which has fallen from 82,000 to 63,000 over those 15 days. I think everybody on X or on social media oftentimes loses their minds when the price falls, but it's not a complicated reason why this is happening. It's a massive vacuum. Every single investment bank on Wall Street is out there marketing the Anthropic deal, the OpenAI deal, the Google deal, the SpaceX deal, and everybody is got to come up with $400 billion of cash. And they're selling credit instruments, private credit, public credit. They're selling software as a service companies. Anything that looks stable, they're selling Bitcoin. They're rolling into the hot new issues. And that actually is the primary dynamic, I think, driving the market this week, this month. And it'll probably continue as long as these mega IPOs come. In the history of the world, there's never been $80 billion IPOs. And we're getting like 1, 2, 3, 4, 5. This is going to be the biggest year of IPOs and equity issuance in our lifetime. How will the market react? You can see, I mean, there's just a massive amount of volatility. You know, sometimes things surging, sometimes they're crashing. I don't think any part of the market's immune to that.
Personally, I think Michael Saylor may be onto something. Not because Bitcoin's long-term thesis has suddenly changed. Not because the 4-year cycle is dead. But because this market may be dealing with forces that previous Bitcoin cycles never had to absorb. For months, investors have watched Bitcoin and crypto struggle while AI stocks, software companies, and major equity indexes continued climbing higher. Many interpreted that divergence as weakness. Some even concluded that the crypto story was breaking down. But Tom Lee sees something different. According to Lee, beneath the surface of this market, there are powerful cross-currents creating temporary pressure. Stocks have performed exceptionally well, and whenever markets move this far, this fast, investors naturally begin worrying about the air pocket underneath. Then came a series of new jitters. Questions emerged about whether the AI trade could maintain its momentum. At the same time, some of the largest capital raises in modern history began appearing on the horizon. Google increasing spending, SpaceX reportedly valued near $400 billion, Anthropic approaching valuations above $70 billion, OpenAI commanding enormous investor demand, and Meta continuing its aggressive AI build-out. Think about that for a moment. That's hundreds of billions of dollars competing for the same pool of institutional capital. Money doesn't appear from thin air. It rotates, it reallocates, it searches for the next opportunity. And that may explain why some risk assets, including Bitcoin, have struggled despite strong long-term fundamentals. Yet Tom Lee remains clear on one point. He believes the bull market is still intact. The headlines may scream danger. The volatility may shake confidence. But beneath the noise, the foundation appears stronger than most investors realize. The real question is whether this pullback is signaling weakness or simply preparing the market for what comes next.
As you know, stocks had done well for some time. So I think there's a lot of people that are worried about the air gap below because so many stocks move so quickly. And then jitters emerged. I'd say 3 jitters emerged last week. The first is, how strong is the AI trade, especially with some of the guidance that came out of Broadcom. The second, of course, is just the realization that Google is going to raise $80 billion plus SpaceX 75, OpenAI maybe 100, Anthropic 75, and then Meta, of course, filed as well. So there's a lot of equity being raised and asking the public to fund that. And the third is, of course, the geopolitical tensions. I think people get generally nervous into a weekend and they're worried about whether there could be something happening in Iran. So I think those are the jitters. And as you know, we get these pullbacks. In our opinion, and we commented over the weekend on this, I think it's a false narrative to think the bull market is in trouble. I think the bull market's still intact and in very good shape. There is going to be a lot of tension in markets until June 12th, because I'd say there's a very large camp of our institutional investor clients that would say SpaceX is going to be the market top. So they're anticipating the markets to wobble. So what they're going to do is take profits and be cautious onto that date. But I'd say that history shows that the SpaceX IPO should not actually mark the market top. It's actually rare a big IPO marks a top. So to us, I think it's actually misplaced concerns. There's still $7 trillion of cash on the sidelines, and we already know the book's been filled. High net worth clients have a lot of cash available to buy this IPO. So I think the market's going to not only absorb this IPO really well, but I think the market's going to do well post-IPO.
If you only had a fixed amount of money, Tom, would you invest in these IPOs?
These are some of the most important companies led by what they call N of 1 people. I mean, I don't know if there will be another Elon Musk in our generation. So for investors who have not owned Tesla, this is a chance for them to have exposure to Elon Musk and all of what he's envisioned. And again, the addressable market for AI and especially data center, and as you move into space, is actually sizable.